everyone. I'm Sandy Casella with Casella Homes Real Estate, and today I'm talking to Sudhendu. And Sudhendu is a business development manager with GNE Mortgages, and he has a fantastic product, and some of my clients have taken advantage of it. I'm actually telling everybody about this product, and we'll get into it. But Sue, tell us a little bit about what you do. Go ahead, introduce yourself and a little bit about what you do, and we'll go from
Awesome.
there.
Thank you, Sandy, for the introduction. It's a pleasure to see you, and it's a pleasure to see your audience as well. My name is Sudhendu. I also go by Sud, just a short form. I currently work as a business development manager across Canada for GNE Mortgages. We are a brokerage situated in Mississauga with about 200 plus agents as of today, and $1 billion in sales volume for the past, 6-7 years running. So yeah, we do actually indulge in a lot of different kind of deals. Of course, we have, the cookie cutter residential first, second mortgages, new purchases and stuff. But apart from that, we have always endeavored to find niche solutions. Because what happens is that's a market which often gets overlooked, right? So be it in commercial space, be it in the farm lending sector, or we are talking about, let's say, a flip financing, which is how we came into contact with each other. So there's different kind of alternative methods to kind of get to your destination, and that's what we really work upon, specifically within the company. I manage a team of 170-ish agents. I'm responsible for mentoring them, discussing deals with them, trying to understand the strategies for every deal, and just guide them towards it. And then I also conduct training sessions. So that's in a gist what I do.
Yeah, that's amazing. And you know what? I'm just so happy to hear you talk about not only doing like the regular deals, but doing these niche things outside. Because I think that a big issue that we have today is that everybody's kind of, I'm going to use, for lack of a better word, brainwashed that you need to go to one of the big 5 banks to get a mortgage. And that is not the case all the time. And I'll just share a quick story about my journey. So when I was 22, I bought my first house. My husband and I bought a house together at 22. We had no idea what we were doing. We didn't have any, we didn't ask our families didn't even know that we were buying a house. We had literally like took mason jars, and every day we got home, we stuck all the change in each jar. So we had quarters, nickels, dimes. I mean, we had dollar bills and $2 bills back then. So long ago it was, but
yeah,
we literally put that money in the jars every day. And then every week we would go to the bank and deposit that money in the bank. And that's how we saved a down payment. And when I went to the bank, so we went out, we bought a house. I've told the story before, but I'm going to tell it again. We went out and we were working with this real estate agent who was fantastic. We put an offer in on a house, and then we got cold feet. Like, we just got really scared. And so we said to her, we wanted to back out of the house. And she said, "Are you sure?" And we said, "Yeah." And she said, "Okay." This was in 1986. So she like, we got out of the deal on financing, whatever it was. But I didn't even, like, back then I didn't even understand this. And she ended up selling the house a few days later for more money, so it was fine. Then we went to an open house. We put in an offer. We got the agreement of purchase and sale. I went to the bank, CIBC Bank. I went to the bank and I said to them, "I want to get a mortgage for this house." And she said, "I'm really sorry, but we can't finance this house because the lot's only 20 feet wide, and we don't finance anything that's less than 22 feet." Back then, had to be more than 22 feet.
Yeah.
So I said, "Okay, no problem." And she said, "Well, what are you going to do?" And I said, "I just won't buy the house." And she said, "Well, you have to buy the house." And I said, "What are you talking about?" And she said, "This deal is firm." And I said, "What's firm?" Like, I didn't even know what that meant, right? So she said, "Well, it means that you have no," like, I didn't know what conditions were. I didn't know what it meant to be firm. I had no idea.
Right.
So you can imagine 2 22-year-old kids walking into an open house. An agent gets us to write a deal and doesn't explain any of that. That's a whole other, that could be a whole other thing, because that agent wasn't working for us, whatever.
Right.
So we went and we ended up looking around, and we ended up getting in contact with a mortgage broker who we ended up working with for years. We started flipping houses and we ended up working with him for years. My point is that people get too caught up in this thing that it has to be one of the big lenders. It has to be TD or Scotia or whatever. And if I can't go that route, I'm not going to do it. Maybe the rates are a little bit higher or whatever. And what they don't understand is that get yourself in the door, get your foot in the door. There's so many different ways to invest in real estate today. It doesn't have to look like going and buying a property and it's the exact property you want. And you get traditional financing. Sometimes at the beginning, you have to take other routes to get where you want to go. And it's so important for people to understand that. That's why I'm happy to hear you say these things, because there's so many ways to get into the market right now, but people are afraid.
And to add to that, right, see, big banks, because they are such large conglomerates, their risk strategy is very risk averse. They don't like to take much risk. And naturally so, because a lot of people's livelihood, money, everything is dependent on them, right? If one of the big bank fails, it's going to be devastating for the economy. So I get how their products are structured and why that is. But I mean, especially in current market, I don't think you can save money in mason jars and buy a property anymore. It's just not what it is. You do have property prices averaging about $800,000-900,000 nowadays for like a single family, decent 1,500 square foot house in GTA, right? So when it comes to those higher loan amounts, the cost of living, your salary, your paychecks are not kind of keeping up with the market prices right now. So sometimes you do have to go a different route, because what matters is getting that property, getting that house, getting that home where you're gonna plant your roots, where you're gonna grow a family. Maybe it's, it holds a lot of different meaning for different people, but that emotional angle is what we need to cater to along with the numbers. That's what I would say as mortgage brokers is what we endeavor to do. Because if you don't understand the emotions behind something, and you just see the numbers and you just talk about whether you're going to qualify or not qualify or what the rate's going to be, then I think you're missing on a major, major chunk of life that happens outside of those numbers. So yeah, I absolutely agree with you.
Yeah, you're speaking my language. You're speaking my language. It's all about there's a lot of emotion that goes into it. People buy with their heart, justify with their head.
Yeah.
So talk a little bit, I guess, about the difference between, like, I believe, for a lot of people, just in terms of the way people are employed these days, going through a mortgage broker is just the natural progression, because like you say, I mean, banks have a job to do, and they have a certain market that they cater to. And we have a strong country because our banks are so strong. So, we may complain about that, but that's the truth, right? And that's a good thing. We want our banks to be strong. So, like, as a realtor, it's a lot harder for me to go through a bank to get a mortgage broker. If you're self-employed, if you're contract work, if you're, anything outside that traditional box, which a lot of people are these days, right? They don't have that, steady, or not steady, that's not the word. They're not employed, let's say, by a company, get, regular pay. Lots of people do, but some people don't. So then you have to go outside of that. So what would be the difference between, I think there's some misconceptions about going through a broker, that it's expensive or things like that. What would you say is the difference between going through a broker and going through a bank?
It's very simple. With a bank, any employee, a mortgage specialist, a financial advisor that you meet, they are bound by their products, right? They are only able to offer the products that the bank offers, and then they would try to fit you into that mold, which, it might work out for some people, and that's great. And as a broker, it is our fiduciary duty as well, that if a client qualifies with a traditional bank at great interest rates, I can absolutely not take them anywhere else. Otherwise, there's a lot of different regulations that I would be breaking, and we really don't want to do that. Very simply, it's there's a change that's being seen in the market. Yes, you do have people who make a great salary. They're buying houses within their means, and banks might be a good option for them. But you should always understand that a bank is going to give you an offer that works best for the bank, right? because they don't really need to go out and take hunt for business. It just comes naturally because of the brand that they have. Whereas when it comes to a mortgage broker, there's a couple of advantages that you get. One is you get unbiased advice. I don't care if you go to a Scotia or a BMO or a TD, or you go to a community trust, home trust, or any other alternative lender. For me, they are all the same. What matters to me is what's best for my client, right? And I do have to justify that. I just can't claim that it's best for the client. Second thing is, when you go to individual banks to get each bank's offer, you kind of take a great hit on your credit even before you actually apply for a mortgage. Whereas with a broker, most of the time we don't even pull credits. By the time we pull the credits, we already know what the strategy is going to be for this particular client, and we just want to make sure that the credit part looks good, right? So that's another advantage. We don't like to do too many credit hits. We identify the bank and the product upfront before we make a submission and have that credit hits on your profile. The third thing is the service matters. Okay, there's a reason why I always compare it with automotive industry. There's a reason why you have a different experience buying a Civic and you have a different experience buying, let's say, a Range Rover or a Rolls Royce, right? It's all about the service, because when things are going smooth, there's no issues whatsoever. But whenever you have hiccups, it helps to have a champion in your corner who's going to fight for you. So I think those are some of the reasons why you should visit a mortgage broker first. Try to understand what kind of mortgages or what kind of financing you get qualified for. Most of the people, those who are doing their own businesses, much like yourself, realtors, lawyers, dentists, doctors, right? It's very hard for them to get bank financing, because I understand that there are, the tax implications is different when you become a self-employed person, and you do want to save a lot of taxes. You do want to do a lot of tax shielding as much as you can, right? But then the problem is it becomes tough to qualify with a bank. So for those individuals, those who do make money, those who are, having good profiles, it's just not present on paper. We could really help them get that alternative financing. And even alternative financing is not that costly as it's believed to be. It's actually just 0.5 or 0.7% higher than what you would pay on a regular bank mortgage. So yeah, there's lots of different stuff that we do. It's just that there's so many misconceptions. I would highly advise people to talk to a broker, see what experience you get before just going to individual banks and trying to qualify with them.
Yeah, I agree. And it's, I think the way I typically explain it to clients, it's like you going to shop for a car or whatever, and you go to Honda, you go to Ford, you go to GMC, whatever.
Right.
What the broker is doing is shopping everybody for you. So instead of you walking into TD and asking them, Scotia, all those banks, the broker is going to shop that around, and the broker is going to know with your profile where is, like, who services that type of a client, which is means you don't have to do that. The broker is acting for you to do that. So I think that's really important for people to understand, because in the majority of cases with a mortgage broker, it doesn't cost you. The broker is getting paid through the bank. Like, it's not costing you out of your pocket to use a mortgage broker. They're doing the shopping around, they're representing you. Like you said, it's your fiduciary duty to explain these things, right? Of, you know what, this bank has this rate and this bank's rate is a tiny bit higher, but their terms are better. Because sometimes that's important, knowing that you're only going to live in a house for a short period of time. Let's don't get a low rate where we have a high payout at the end, because in that case it doesn't work for you. So I think that's what a broker does really well.
Yeah, especially when it comes to investors in real estate, right? I know right now it's a little bit slow because people are kind of just a little wary of going into real estate as investment at this point. But when you talk about, on a longer scale, 5, 10, 15 years, real estate has always been a lucrative investment, right? It's safe. It's, it's something of value, which appreciates over time. So it's been great. And it also provides you cash flow. But what happens is once you own, let's say, 2 or maximum 3 properties, after that, anything that you want to build into your portfolio, it's only a mortgage broker that can help you at this point.
Yeah.
Right. Because banks, like I said, they are always a little bit more risk averse compared to other lenders. And regardless of whichever lender you go to, they are all governed by the same rules, by the same laws that exist for the banks. So it's a completely safe option. It's just that they are providing alternative financing for people who usually wouldn't qualify with a traditional bank. That's the only difference. Regarding how the broker gets paid, most of the time we get paid from the bank, whether it's the top 5 or any other alternative lenders. Majority of the time we get paid. Yes, if you do have, let's say, a very bad credit score, below 500, or there's some other issues with your profile, and we do have to go for a private financing, let's say for a year or two. Again, private financing, huge stigma associated, but those are band-aid options. Those are never full-term options, right? But it does help a certain section of society, and it does help people who would otherwise get overlooked. So that's a good option. Those would be the only deals where we charge the client, right? Again, it does not come out of client's pocket. We usually take from the proceeds of the mortgage. So it's been accounted for in the mortgage amount that you qualify. But yeah, there's lots of interesting things. I think you should definitely talk to a broker before you decide to enter into the real estate market.
Yeah. And like you say, there's a lot of different options. So if you're, if you really want to get into the market and your credit is shaky or whatever, speaking to a mortgage broker can typically package it for you somehow, some way. There's a lot of people that have a high income, like you said, but they don't claim that money. So it's a little more difficult. So yes, they have to, I think people look at it the wrong way. Like, yes, you have to pay more interest. However, you're not paying tax on that money. Like let's be honest, you're paying that money somewhere, somehow, right? So you're paying more interest on the property. You're maybe not paying the tax on that, on the income that's coming in. So I mean, that's a whole other, that's a whole other thing. However, I think it's important to understand, like you said, about like going private or going with an alternative lender, like a B lender or whatever. Sometimes that's just the way to get into the market. So I'll give you another one of my stories. Like when my marriage ended and I left, and I was in debt. I was in a lot of debt, and all I had was the proceeds. I had the proceeds of sale from the property that we sold and split it in half, and it was about half of what I owed in debt.
Wow.
And so I said to myself, well, I'm either going to pay that debt and still owe half of that, and because I'm in real estate and I'm a huge believer in buying real estate, I said, I'll just buy the best house I can buy with the down payment that I have. And I went through a B lender, and yes, the interest rate was a little bit higher. And I said to them, just give me the mortgage for 1 year. And in 1 year, I'll go with an A lender. And they said, well, you won't be able to fix your credit in a year. Should do 2 or 3. And I was like, no, just give me a year. And worked like crazy. And after that year, was able to transfer over to, at that point, Scotiabank. So it's a means to an ends. But if I had said at that point, well, I'm just going to wait and keep saving money, or I'm going to pay off that debt, I would never have been able to buy, because this was, I guess I'm going to say about 10 years ago, 11 years ago. Imagine if I had waited, like the market skyrocketed. That house that I bought, I paid $390 for that house back then, and I ended up selling that house for $900,000. So imagine I had said to myself, now I did renovate it, don't get me wrong. So I did put a lot of money into it. However, if I had said to myself, I'm just going to wait until I have more money, well, it just wouldn't have happened. So the debt got paid off. I was able to go with an A lender. I mean, it took a lot of hard work, but my point is just that where there's a will, there's a way. Like it can be done. We have to think outside the box. And that's why I like how you said that. So for young people who say they'll never be able to buy, well, maybe you'll never be able to buy in Toronto, but you may be able to buy in other places. You may be able to invest in real estate in different ways to get yourself in there, build some equity, and then kind of move up. But this market right now, we have low rates, we have low prices. This is what everybody was waiting for. What we don't have is buyer confidence. This is where
Yeah.
people make money. Like, this
Yeah.
is what breaks my heart, is to see these kind of markets and to see people who are afraid. Real estate is not going to crash. Like, let's be honest. We live in a country that home ownership is valued by 99% of the people. Our market will recover. It will recover, and it will recover fast. And all it's going to take is a couple of articles in the newspaper saying that the market is starting to turn. Because if you're waiting for the bottom, you can't know you're at the bottom. You don't know you're at the bottom until it starts to go up. So
Yeah.
this is where people make money. And you have to be not afraid to do it. So if you're waiting, you're always going to be waiting.
Yeah, absolutely. I mean, any market, right? Whether it's stock market, whether it's real estate market, you can never time things. It's not about timing your entry or exit in the market. It's about the time you spend in the market. So right now, what's happened is it's a buyer's market. Yes, we are expecting a couple of more rate drops, so people are a little bit on the fence even now, and the prices are also cooling off. But see, it's never about getting in at the lowest price or the highest price or anything. It's always about what is your comfort, how much can you afford, and if you can afford it, how does it matter if the interest rate on the paper says 10% or 2%, right? As long as you can afford the asset, as long as it's a good home in a good area, something that you really wanted to buy and to live and to grow a family and to plant your roots into, the interest rate on the paper absolutely makes no difference as long as the monthly payments are well within your comfort. So it's futile to time the market. Whenever you feel you're getting a good house that you like, and the prices are also within your budget, I think you should just enter regardless of whether it's going to go further down or whether it's going to go up or the interest rate's going to change or not going to change. It doesn't really make any difference because nobody can time the markets, not even the best investors.
And we never know what's going to happen. Look at the last few years. I mean, who could have foreseen a lot of what's happened? So,
Yeah.
uh, so you're right about that. So I want to talk about some of the alternative products that you have, in
Mhm.
particular the product that you have for people who want to flip houses, because I think this is absolutely brilliant. And I
Right.
know that we have one client who's taken advantage of it already, and another one that we're working on.
Mhm.
I just think this is fantastic. I want you to explain it, and how this works, and so people can understand.
Right. So, as I said before, we are not in 1988 now. So house prices are crazy, right? It's hard for a lot of young couples, especially. I mean, I don't think I have seen a 22-year-old buying a house in a very long time, and even if they do, it's always a major chunk of the down payment coming from the bank of mom and pop, right? So it's in a nutshell, it's very tough. But you do have some opportunities in the market. For example, the client that we worked together on, she was a single lady, 26, 27-year-old. Her mother was helping her out, but your income is not super high at this age. You're probably somewhere around 80 to $100,000 income. And if you have to buy a house for 600,000, 700,000, it becomes difficult unless you have, like, let's say 250 or 300,000 as down payment, right? But there are some opportunities. For example, the flip financing. You specifically hunt for houses which are priced way below market. And yes, they are priced below because they have some issues. I won't say major issues, it's just some cosmetic upgrades that you need, right? Maybe you need to change the roof a little bit, maybe you need to change the tiles, upgrade the basement, or do some minor renovations and minor work here and there. Um, and you do have a lot of potential in those properties. For example, the one that we worked on, the client got the property for 300,000, where similar houses were being sold for about 650 in the same locality. The reason was the house needed maybe like 50 or 60,000 in cosmetic upgrades. So they had a quotation from the contractors beforehand. They knew exactly what they were getting into. So yes, you have to do your homework. You have to understand what you need to do to the property even before you put an offer on it, right? So we got the financing done for them. The best part about the product that we have for flip financing is you can start with as low as just 10,000 down payment. And that's regardless of property value, up to a maximum of $800,000, right?
Purchase
So
price. Yeah.
purchase price, yes. So technically, if I'm, let's say, buying a $600,000 house, 10% is, sorry, $10,000 is not even 1.6%, right? But you can get into it. You save other money that you have for the renovations. You get in 2 months, 2.5 months max. You do all the renovations. Then it might take you some more time to sell that property if your intention is to sell it as a flip. Or if you want to keep it, then as soon as your renovations are done, the market, the property is brought to marketable value. And then it's very easy for us to go with any bank, right? Because traditional lenders would definitely shy away from these kind of deals, not because your client has an issue. Their income is good, their credit scores are good, they're qualified in every sense. But lenders also look at the property. Is it in marketable condition as is, right? Because the question for the lenders is, if the client, let's say for whatever reason, stops paying and we have to take over the house, then are we able to market it in how much time? And what's the least amount of expenses that we will have to maintain this property until it gets sold? So from that perspective, your clients might be stellar, but the property itself might not qualify. But we can solve that problem with different kinds of lenders. Now, similar to that, we also have other means. So when it comes to alternative financing, we have no income verification products. So let's say if you're making cash income, or if you have, non-traditional sources of income, we could definitely help you with that. We are also doing stated income financing. So basically, all the business owners like yourself, we know that the tax returns are not that high purely because you want to shield your taxes, right? And it's a legal way to do it. So might as well take advantage of it. But the flip side is you don't get qualified for a traditional mortgage with a traditional bank. So we could go to some alternative lenders where we will consider your business income instead of your personal income on your tax returns, and will qualify you based on your business. The only difference is, yes, the interest rate, because the bank is taking more risk, the interest rates are going to be like 0.5, 0.6% on the premium side. But that's hardly, it's a great trade-off to pay 0.5% if you're saving about 30, 35% on the tax returns. So it's absolutely no-brainer for me.
Yeah, for sure. And it's also in terms of the property, like, because you're building equity in a property, and make no mistake, these properties are going to go up again. If you're buying a property now, they may go down a little bit, but they're going to go up at some point. The equity that you build there, you can't possibly, like, you can't possibly, most people can't save as fast as you can build equity. That's why I think it's important to get into a market, or get into something as soon as you can, is because that whole reason you're paying down your mortgage, so you're paying yourself every month and you're building equity. And that's a really hard thing to do. So I know some people say that, real estate's not a great or it's not an investment. Some people I see on social media, but they take out, I think the beginning part of what you said is the emotional side of it, because you're not going to get emotional and attached and with a stock. Like, you might, but it's not the same as a house, right? Bringing up your family in a house, or having a safe haven to go to, having a place to go to, means a lot. And you're never going to get that with a stock. And I think, with if you own a property and you have equity, let's take two scenarios. Let's say you own a property, you have equity in that property, or you're renting and you lose your job. Chances are you are going to find another. Let's say it takes you 4 or 5 months to find another job. If you're renting and you're not paying your rent, you are going to be asked to leave at some point. If you own a property, the banks will work with you. You can work with the banks on getting that mortgage, paying that mortgage, because the bank doesn't want the house, put it that way.
Yeah.
You make arrangements with the bank to be able to pay that, or maybe you can take some equity out to use if when you have your job, let's say you have a line of credit on the house that you don't use, you can
Mhm.
fall back on that. Whereas when you're renting, you can't. Like
Yeah.
there's just a lot more that you can do when you own a property.
Absolutely, absolutely. See, it's an asset at the end of the day. And the equity growth that you get with the housing market now, I do get it that the last 2 years have been a little tumultuous. And that's also because the 3 years prior to that, real estate was going up like crazy. I mean,
Yeah.
there was so much overbidding on prices. I've seen houses listed for 799 getting sold for 1.1. So,
Mhm.
see, it's a bubble on when it's going in an upward curve, it does create a bubble.
Yeah.
And same happens when it's going down as well, right? Now that the properties have, just cooled off a little bit, market is a little bit more stable, you can see that the prices are coming down roughly around 15 to 30% in different pockets of Ontario. But when you compare it with a longer term, right? If you look at it at a 10-year window, um, then properties will always appreciate in value. And the mortgage that you have, because you're making multiple payments, it will always diminish. So you will always keep building that equity. Second thing coming, like I just had a spark when you said, people should tap into their houses when going gets tough. Please, if you have a free and clear house, or if you have enough equity in the house, it's always wise to have a line of credit associated with it. Get a HELOC. If you don't use it, you don't pay for it. So don't worry about it. Uh, Especially if you're a business owner, because of the nature of all businesses, you always have your highs and your lows, and you need a credit facility. You are never going to get a credit facility in your life with as low an interest as you would get on a HELOC. Okay. Second thing is, um, you may not qualify when your situation is bad. You may not qualify for it. So you should always have it set up when your situation is great. You're having a job, you're making income, everything is good. Have that HELOC, set it up. Your admin expenses or setup expenses might hardly be a few $1,000s, but it's going to be there on your house for as long as you live in it. And that's readily available cash at any point of time for whatever you want to do in your life. So it's always a good idea to have a HELOC against your house. um, and yeah, I mean, basically it's just understanding the strategies of how best you can leverage what assets you have.
Yeah, absolutely. Yeah, I love that. Just
Yeah.
don't use it as an ATM. Just
No.
don't use it for frivolous things, but have it there, like you
Yeah.
say, for, sometimes those emergencies come up. I mean, best case scenario, you have,
Yeah.
6 months worth of cash in the bank that you can fall back on, but sometimes, things happen. So I totally agree with you.
Yeah.
Just, you can't get that in a property. If you rent the property, you
Yeah.
just can't get that. So
Yeah.
I think it's a really great idea. In
Yeah.
terms of other products, are there any, because I don't want, in interest of time, I don't want to keep you here forever, because I do appreciate you being here. Is there any other products that you wanted to highlight at this point?
Yeah, so we do have a lot of other products. What we are seeing right now is most of the real estate investors, because they're a little bit disillusioned with the residential side of things, they are now getting into commercial space,
Mm,
because those are the only cash flow positive properties at this point of time. Another, I think, big game changer, especially for seasoned investors, is getting into this multifamily properties, right?
mm,
So that is also a great product to have. You could technically own let's say, a 20-unit apartment with as low as 5 to 10% down. Yes, the qualification is a little bit different, but it absolutely does not depend on your personal profile, although you need to have a strong net worth and, other stuff. But it mostly depends on the property itself. So if the property is producing, positive cash flow, you will qualify. You will get it with as low as 5% down. You get 40 or 50-year amortizations on those. So the longer the amortization, yes, you pay more in interest, but you pay less per month, right? You
Oh,
take your
wow. Yeah.
costs way, way down. And these are insured by CMHC. So the interest rates are also going to be super attractive. May not be 3% or 3.5% as we see on the housing side, but it's definitely going to be around 4.5% for the most part, right?
Wow, that's incredible.
Yeah, so that's one. Second thing, for people who are a little bit on, post-retirement, let's say they are 60, 65 years old, what happens after retirement is you lose a major chunk of your income, right? You're now dependent on the pensions and whatever government support that you're getting. Um, it's very hard to qualify for any credit facility at that point of time. So most often what we see is these guys have houses which are paid off, but they need a little bit of funds for, let's say, passing it down to their children or grandchildren for their house purchase,
Hmm.
or just supplementing their their pension income, um, or if it is just some major chunk that they need for their medical expenses or whatnot. Reverse mortgages is a very good solution for those clients as well. Now, of course, just like any other loan, you do have to understand whether it's the right fit for you, right? But more often than not, if you don't go for reverse, the only other option you have is a private mortgage because your income's not present. You do have to go for non-income products. And then that's the challenge, right? You're trying to solve your cash flow problems by getting some money, but now you're paying more money per month. So it's like a never-ending cycle that you will get trapped into,
Yeah,
right?
that's a good point. Are those pretty popular right now as the reverse mortgages?
Yes. So what happens is there was a lot of stigma associated with them, especially
Yeah.
with certain communities, because people felt that their house will they'll just lose their houses to the bank.
Mhm.
But nowadays the products are so simple. First of all, you will never lose your house because these loans are done at 50 or 55% of your house value maximum, right?
Mhm.
So you don't need to pay anything back. You can absolutely think of it as a line of credit. You
Yeah.
pay the minimum, you can pay a little extra amount, you can pay it off at any point of time if you so choose to. You can pay half of it at any point of time if you so choose to. So you can actually pay whatever amount you want. And above and beyond a line of credit, if you decide not to pay anything, that's also okay, for as long as the last partner is alive or you sell the house, one of the
Or
two.
you sell the house, right?
Yes.
Yeah. Yeah. Wow. Okay.
Yes, so it's a great solution. And even at the end of it all, the question is, will I pass down anything to the future generations, right? Because otherwise, what's my legacy? Well, if you take a traditional financing, whatever happens after you go is the same stuff that happens with a reverse mortgage. You do pass on a lot of equity or the house itself. The next generation can just choose to refinance, get a mortgage from a bank because they are working, they're in the workforce,
Yeah.
and just pay off the reverse one away, and you still have a house with a mortgage, just like what you would pass down any other way. So it's the same estate process. It's everything is the same. You never lose your house to the bank
Mhm.
because usually houses appreciate at a higher value than the interest rate on it. And in any case, the mortgage is restricted to 55% of the house value. So it never really overtakes the entire value.
Right. Oh, okay. That's interesting. That's good to
Yeah.
know.
Yeah.
Yeah. I have a question for you. So what about for people? I mean, the problem that we run into sometimes with people is that they're buying a property and all their equity is tied up in that, or sorry, they own a property and they're buying another one, their equity's tied up in the first house, and they
Mm,
have a deposit to put down on the second house. If
right.
you don't have a line, that's a good reason as well to have a line of credit, because if you have a line of credit, you can use it and we get transferred. But how do you have a product that could help people with that?
Absolutely. Yes. So a line of credit is always a great product. Now, line of credits are offered by multiple institutions. We check how you can qualify and what you can qualify for. But suffice it to say that even if your credit score is, let's say, 500, 550, your income is irregular or cash income or non-traditional sources of income, your ratios might be very high, you might have, excuse me, other debts in your life, we would still be able to qualify you for a HELOC. So that's number one.
Mhm.
Second is sometimes we don't even have to do two different transactions. We can just, cross tag multiple properties and use something called as a global equity. So it's a concept where all your assets and all your mortgages are combined together and we see what the ratio comes up to. As long as it's less than 80%, we are able to cross tag multiple properties while not having to do multiple separate applications.
Mm,
So
okay.
that's another thing that we can explore. Sometimes you have a vendor take back, if especially if you're looking at commercial properties. The seller themselves give a part of the purchase price as a mortgage or as a loan to you, and you
Yeah.
pay that off in the next 1 or 2 years, right? So there's multiple ways in which we can strategize. It really depends on the client's profile, the property type that they are looking at, and then certain special considerations that we might have for every deal.
Yeah. Yeah. Well, that's wonderful. Well, I really, I want to thank you for taking the time to talk to me. Some of this is, I mean,
Right?
it's great information for people. And I think it's, even if I think you're just kind of starting out or you're thinking about buying, it's really
Mhm.
good to have a conversation with someone like you. And that way you can set yourself up, like, what do I need to do to be able to buy, and when would that be, right? Because I
Right.
think that's a lot of the problem is people, especially, kids coming out of school,
Mhm.
they're not taught about mortgages. Most people, I mean, I know adults who don't know what a mortgage is. So
Yeah.
to understand, okay, this is what I would need to do to buy a house, let's say in a year or 2 years, whatever, to get you on that path to doing that, I think is really important, getting that information. You don't have to be ready to do it right now. And I think that would be, that's what I would advise a lot of. Like, I just love when young people buy houses, especially young females. Like, I think it's so empowering. And just knowing
Yeah.
my own story and how it's been able to help me, that's why I'm so passionate about it.
Sure.
Um, I do have one question for you that's come to mind. So I know, like, with some people, let's say like influencers, some social media influencers, they make some pretty decent money doing
Yeah.
that. How would you be able to qualify someone like that?
Absolutely. So yes, social media influencers, it's a crazy phenomenon that we have seen, especially since COVID. And trust me, some of those influencers make so much income. It's
Mhm.
crazy, right?
Yeah.
And I understand the hustle behind it. The problem is, just like any other business, I cannot predict that you will make the same money year over year over
Right.
year, right? Second thing is, it's the big thing now, but I don't know what the future of this industry is going to be from a lender's perspective, right? Having said that, these guys are, it has just been a blast in the market. There are so many influencers buying so many properties. Some of them are so successful that they don't even need a mortgage, which is great. But many of them, just like you and me, they do have those amazing time in the markets where they are making a lot of income, and then they have their dull period where they're not making as much. The same alternative financing categories would exist for them too. We would look at their overall business income. We would look at their net worth. Uh, Most of them nowadays have investments into Bitcoin and cryptocurrency and all of that. So there are lenders who would look at that portfolio for net worth requirements as well. Um, we also have net worth programs, right? So your monthly income might not be that high, but if you have investments, we could kind of trade that for getting you a bank mortgage with, let's say, TD or Scotia. So there are multiple ways in which people assess individual profiles. And because of that, there's a plethora of products that can help you out depending on what particular parameter we need to work on. So yeah, but influencers are definitely going to grow in number. It is going to
Mhm.
be it's already a formal industry, but it's going to cement its position. And with the way things are going, with everything that's changing in the market, the job markets, the traditional roles that existed, they're kind of getting phased out by AI. They are, you don't need as many people for the same role anymore. So many young people are going to start going towards these alternative careers, and it's only going to pick up from here. For us, it's a little bit difficult because we have been brought up in a different era, but
Mhm.
the children who are now growing up, they are growing up with mobiles and AI technology and all of that around them since birth. So naturally, they're going to adapt to it like fish to water, and we're going to see these alternative careers, just pick up a lot as we progress. Let's say 5 or 10 years down the line.
Yeah, I 100% agree with you. The reason I ask is because I know somebody, I know an influencer
Mm-hmm.
who is a young woman, and she was looking for a job, moved from one city to another and was looking for a job and couldn't
Right.
find a job, and just couldn't get hired anywhere. It's very tough to find a job right now. So you talk about trying to save money in mason jars. You got to even be able to find a job to be able to do that, right?
Yeah.
And couldn't find a job. Has a part-time job, but couldn't find a job somewhere else, and just started doing stuff online and became an influencer.
Yeah.
And the thing I think about here is some people, like the banks, won't finance that. Now, here's my take on this, and this is totally different, but
Yeah.
you have somebody who can't find a job, could go on welfare or whatever it is, like government assistance and whatever,
Mm-hmm.
but decides to go and find a way to make money, whether that's a self-employed, like a
Yeah.
dog walker, whatever it is,
Yeah.
influencer. That person, I would much rather finance that person than the person who never tries anything different, because to me, that person is always going to find a way to make it work. That's how I look at it. Now, I know the banks don't look at it that way. They're totally different. However,
Yeah.
it's just a thought that went through my head at that time. Like, I would love to hire somebody like that, because to me,
Yeah.
that person is a problem solver, and that person is going to figure out a way to do what they want to get done. So I think it's important, but like I say, it could be any job. It doesn't have to be influence. Could be, like I said, could be a dog walker. Could be
Yeah.
whatever.
Yeah.
That's you're figuring out a way to pay your bills, and I think that's really important.
Absolutely. So what happens is people, and mostly underwriters, they get caught up in the what we call as the 4 C's of credit, right? There are actually 5, but most people are just hinged upon the credit history. That's your first C, right? So your credit score, your history, how you have managed your accounts, and so on and so forth. The capacity or the income that you have, how much you can pay month over month. Your ratios come into the picture in this. Then the third one is capital, which is your down payment. How much equity are you owning outright and how
Mhm.
much mortgage you are getting. And the fourth point is collateral, the property itself. How good is it? Is it marketable? All of those things. But there is a fifth C of credit, which is, hard to define because it's not about numbers. All the other 4, they're numbers. So you can stack them up, you can look at them, you can analyze them, and you will have your own inferences. But the fifth C of credit is character, right?
Mm.
It's very hard to quantify. It's, it depends from profile to profile, from person to person. But if your client has the intent, the wits, and the enterprise to do whatever it takes to pay the mortgage, to get the house, to run their house, all their monthly bill payments, then that intent, that character is very, very strong. And if that part is strong, the rest 4, we can kind of tweak it. We can kind of make adjustments to make sure that everything fits together. But yeah, this is one thing which often gets overlooked because it's not numbers. You cannot really analyze it as such. It's something that's not discussed a lot, but it is something that's seen by the underwriters, that's seen by the
Mm.
banks.
That's
Yeah,
amazing. I love that,
yeah,
because really, even if you have a job, you can be downsized, you can be let go, you can be laid off. I mean, there's a lot of, it
yeah.
doesn't always going to have that job. So there's always risk. There's risks to everything, right? So
Yep.
I just think somebody who would go out and figure out a way to make it work and then some is
Mhm.
a great prospect rather than someone who will just, spend 2 or 3 years trying to find a job. And then what happens if you let go from that job? The only thing you know is how to go out and find another job, however long that takes. So,
Yeah.
yeah, it's very interesting. So this has been a really interesting conversation. I'm really happy that you joined us. And what I'll let you say where people can reach you, and we will also put all of that in our in the comments or wherever when we post this. They'll have your contact details to reach out to you. And I would highly recommend, if you're watching, if you have questions about this, call soon. Get a plan together. Figure out, if your goal is to buy at some point, if you don't own now, how do I get there? Don't stick listening to the news, because then it's not productive. Get some real information, deal with professionals, deal with people who have the experience, get good information, and move forward from there, and block out all the other noise. Just block it all out, because it doesn't matter. So
Yeah.
I'll let you say how people can reach you, and whatever you want to say in closing as well. Go ahead.
No, absolutely. It's been a pleasure to talk to you. It's always a pleasure to talk to you. And I've always said this: with your experience in the industry, you are an institution yourself, and I learn a lot of things from you. And I will continue to do that. See, there are multiple ways that you can solve a problem. Okay. What you need is someone who takes that initiative and someone who's responsive. And both of those things, we at GNE Mortgages, we try to endeavor, and not just in myself, but my team, my agents, everybody else. If you really are on a, if you are at your wit's end and traditional financing option may or may not be working for you, or you just want to enter real estate market but don't know how to, please reach out to me or Sandy. You can reach out to me on my cell. My cell phone number is 905-247-5656. You can email me. It's my first and last name. So first name dot last name at gnemortgages.com. Or you can just walk into the office. We are in Mississauga. Do a quick search on Google for GNE Mortgages. There's only one, so you will land up at the right spot. And I'll be more than happy to have a chat with you on a coffee.
Amazing, amazing. I'd love to have you on again. We'll talk about a little bit more. We didn't talk a lot about the market and where it's headed today, and the condo market, all that kind of stuff. So I would love to have you on again, and let's dive a little bit deeper into that and where we're going and rates and stuff. So it's been wonderful talking to you, though. Thank you so much. I really appreciate it.
It's a pleasure. Thank you so much, Sandy, for this opportunity. And it's always a pleasure to talk to you and work with you.
Thank you.
Have a great day.
You too.